Could a U.S. technology venture capitalist and an Indian bathroom solutions entrepreneur have anything in common? A lot more than you think. Peter Thiel is one of the founders of PayPal, the first outside investor in Facebook, and the largest shareholder in Palantir, a CIA-backed technology company. Vikram Somany is the founder of Cera Sanitaryware, a mid-sized company focused on sanitaryware such as toilets and wash basins, faucets, and tiles. Separated by continents, time, and industries, neither would have probably heard of the other. But for two people who have probably never heard of each other, their business principles show surprising overlaps. Let's explore those commonalities. Consider Thiel's law. A startup messed up at its foundation cannot be fixed. Bad decisions made early on, if you choose the wrong partners or hire the wrong people, for example, are very hard to correct after they are made. It may take a crisis on the order of bankruptcy before anybody will even try to correct them. Cera's beginnings in 1980 obeyed Thiel's law. Vikram Somany's father was one of the founding members of Hindustan Sanitaryware, the first organized sanitaryware company in India. And so Vikram understood the space. When Cera was started in 1980, it was also staffed with ex-employees of Hindustan Sanitaryware, a giant in the segment by then. The presence of those experienced employees helped the business achieve profitability in the first month. This is quite an achievement considering the fact that manufacturing toilets and basins is a complex process with high startup costs. Another factor which Cera got right from the beginning was its customer focus. India was a closed economy around that time, with the production of even the private sector controlled by the government. Thus, the seller was king, not the customer. Even in this environment, Cera was far ahead of its time and offered a wider variety of colors, designs, and after-sales service to the customer. Peter Thiel advises most startups to start small and not be obsessed by a large target market. He says, "Every startup should start with a very small market. Always err on the side of starting too small. The reason is simple. It's easier to dominate a small market than a large one. If you think your initial market might be too big, it almost certainly is." The perfect target market for a startup is a small group of particular people concentrated together and served by few or no competitors. Any big market is a bad choice, and a big market already served by competing companies is even worse. In a big market, even if you do succeed in gaining a small foothold, you'll have to be satisfied with keeping the lights on. Cutthroat competition means your profits will be zero. And that is exactly what happened to Cera. Cera focused on just the sanitaryware market in the beginning. That is all they did for 25 years. In fact, for the longest period, Cera's target market was much smaller, the value for money segment. Cera stayed away from the premium segment. Sanitaryware breaks easily, which meant it was difficult to transport it properly in ships. And so, the only segment in which imports made commercial sense was the premium range. Thus, by staying in the value for money segment for a long period, it smartly avoided competition from Chinese players and from foreign brands. This once again echoes the strategy suggested by Peter Thiel. Avoid competition as much as possible. Success is not possible in perfect competition. In fact, Cera's evolution is an excellent study on how the focus on small markets can be a powerful advantage. As it was not distracted by other businesses or product lines, it was able to focus on optimizing all aspects of the sanitaryware business. R&D was and continues to remain a major focus for the business. The department, headed by a ceramic scientist, is laser focused on improving the manufacturing process, creating innovative products, improving raw material quality, and reducing costs. Another piece of advice from Peter Thiel in his book was, if you want to create and capture lasting value, don't build an undifferentiated commodity business. Well, Cera was initially a small unit in Mr. Somany's business empire. His business was also producing undifferentiated commodity products like oil and animal feed. But once, over a couple of decades, he saw the economics of the branded business that Cera was slowly evolving into. He had the foresight and the guts to burn his bridges and focus entirely on the Sanitaryware business. Since 2001, Cera has spent more than 4% of revenues on average on brand building efforts and hired leading actors as brand ambassadors, even when it was a really small entity. This allowed it considerable pricing power, as indicated by the fact that the average realization per piece increased from $370 per piece in 2001 to more than $1,200 currently. It also allowed the business to enjoy growth rates much higher than the competition as well. The sales increased at a rate of more than 28% per annum from 2002 to 2015, far higher than that seen by the competitors. When talking about the importance of focusing on small markets, Peter Thiel had a clear idea on how a company should move into adjacent markets. He says, sequencing markets correctly is underrated and it takes discipline to expand gradually. The most successful companies make the core progression to first dominate a specific niche and then scale to adjacent markets. It's part of their founding narrative. Around 25 years after it started business, Cera decided to take a giant step. It decided to start selling faucets as well. The most important factor for Cera was to stay within its circle of competence. Faucets were still primarily a part of the business like Sanitaryware, and so the customer connection would not be lost and the product made logical sense for the brand. Also, the incumbent giant in the industry, Jacquard, was earning great margins and returns on capital above 20%, so the segment made financial sense. Additionally, it helped that the faucet market was more than 3 times the size of the Sanitaryware market, which extended the runway for the company. More than 5 years after its faucet entry, it entered the tiles business, which was around 6 times the size of the Sanitaryware business. The tiles business has similarities to the Sanitaryware business in its raw materials and the manufacturing processes. The end result of all of the above is that from 2001 to 2019, the company's sales increased from $5 million to $190 million, and profits from $60,000 to roughly $16 million. The returns on capital are consistently above 20% and have been so for more than a decade now. It is today one of the leading players in its core markets with a strong foundation and probably one of the largest and most under-penetrated markets in the world. What is perhaps most fascinating about these examples is how similar the success patterns are between two fanatics across different industries and continents with seemingly no overlap. This is what we attempt to study and subsequently share with our members at intelligentfanatics.com. The success patterns of people who have reached stupendous heights in their field of choice. If you'd like to become a member, check out the description below for all the links. And if you enjoyed this video, make sure to subscribe to our channel.